You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again. It is time to rock out on your Wednesday extravaganza, known around the globe as Education Wednesday, aka the home of Options Bootcamp, even though it's the home of other things now, too, as the network continues to expand, including the Futures Rundown and then your daily dose of Thor, the Hot Options Report. If you want to get all that and everything else, nearly a dozen shows, make sure you're checking out the full network wherever you get your favorite podcast programs. Just search for Options Insider Radio Network if you want to get specific. Grab the full network feed. You will get everything. And then, of course, if you want to go above and beyond, you're ready for awesome pro Q&As. We had a great discussion with the folks from Robinhood yesterday about what they're bringing to the table. They're putting up some flow over there at Robinhood. We wanted to see what they're bringing to the table from an options perspective and what new tricks they may have up their sleeve. If you want to find out for yourselves, head on over to theoptionsinsider.com/pro. That's available there now, as well as, of course, options oddities, giveaways, live streams, all sorts of fun. Theoptionsinsider.com/pro is the place to go as we go around the horn, see who's joining us on the old OBC today. And surprise, surprise, we tried changing the locks. He got in again anyway. None other than Dan Passarelli himself, a.k.a. the black-hatted one from Market Taker Mentoring. Mr. P, welcome back to OBC, sir.
Hello, Mark. Hello, everyone. Good to be back. I look forward to it every week, and here we are again. What do you know?
I do know, sir, that we're going to have a good time because we're going to get exotic yet again. Our listeners created a monster. Here we go, listeners. It's time for some more options drills.
Well, in boots, time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to Options Drills, and these are topics that kind of fall between our usual categories and segments. This is obviously not an Options 101 or a basic training, really. We need maybe an Options 201 or 301 drop here for the show, because that's kind of what we're talking about today. Instead, we're sandwiching it into a little bit of Options Drills. If you listen to the recent programs, we had a listener question about look-back options and giving you a taste of some exotic options. And we thought some folks like that taste. They wanted a little bit more. So you know what? We thought we're here for the listeners at the end of the day. So once again, we're going to get exotic this week. I think we're going to tackle a more, I hate to say common because none of these are common, but a more standard use case in the exotic options world, which are effectively barrier options. You might know them as knockout or knock-in options. Dan, when I say those words out loud, what leaps to mind other than a cold trickle of fear running down the back of your neck, sir?
Man, I mean, what really comes to mind is just OTC traders that I know, because, that's typically where we see these more exotic ones trading, and knockouts and knock-ins and all that sort of thing. They don't have those listed standardly yet, and I imagine they never will. I mean, there's just too many variables for it to be liquid, but yeah, I don't know. Lots to talk about.
The key is yet. The exchanges are listing everything over there these days. One day, Dan, some exchange will go crazy and list a knockout or a knock-in. Or maybe not. Once you hear us explain these a little bit, listeners, you may decide you could probably maybe do this better yourself with some listed options. Let's get into exactly what we're talking about. So these are barrier options. As the name implies, something happens. The options either activate, aka knock in, or they deactivate, knockout, when the underlying hits a certain price during the lifespan of the option. So again, you've got your knock-ins. These options only become active. They only come alive in Frankenstein parlance when that barrier, when that level is touched. Knockout, we're flipping that script. Those options go away. They are worthless if that barrier is breached. So there's a variety of use cases, as Dan mentioned, this is all OTC stuff. This is bespoke stuff. So this is usually designed to structure a very specific bit of risk management or hedging, or maybe a little bit of speculative upside. And again, we'll get to those right now. Let's start out with probably maybe the one you've heard of, if you have heard of any of these, maybe the one you've heard of the most frequently, which are knockout options. These are the ones that go the way of the dodo if that barrier level is hit. And they come in two flavors, funky names, Dan. I like the names here. We got the up and out calls and the down and out puts. That'd be a good name if you had to rebrand MTM. How about down and out mentoring? How about that? With you, a picture of you just holding a bag of wine in a paper bag. I like it. What do you think?
I'm not quite sure that fits with our brand.
Who wouldn't want to learn from that guy? You have like a hobo jacket. You're kind of huddled in the corner of an alley. I think there's a lot that could be done with that branding. I will say this. No one else is doing that. So you have that branding to yourself, sir.
The last time we had a mastermind, we had a guy from out of town who's familiar enough with Chicago. And on the last day before he caught his flight, he was bumming around town, and he sends a picture of himself laying in the gutter with a bottle of Malort.
What's he doing making fun of your average Tuesday, sir? How dare that man out there? But yeah, I guess he knows his way around some Chicago cliches. I like it. All right. Let's dive on into these options. Let's start with the up and out, listeners. We'll go to the upside first. Again, we're going back to our old pal XYZ, trading for $100 again. Nice round numbers. And now, in this case, this is a barrier option. This is an up and out call. The barrier in this case is going to be 120. So, and let's go out 3 months. Let's make it a 3-month option. So you're buying a par call, a 100 strike call for 3 months. That's all pretty straightforward. But in this case, you have a barrier. So if the underlying, over the course of that 3 months, trades above 120 at any time, if it just touches that barrier, it doesn't have to close above it. If it just touches it, guess what, Dan? The option is worthless. It is knocked out. It goes away. So that call you buy, if you're a little bit right, okay, you're cool. If you're a lot right, you get to 121. Guess what? Big middle finger to you, sir. What do you think about that?
This stuff starts getting really, really interesting when you start getting into some of these exotics.
Yeah, they're called exotics, maybe not always called smarts. So right. We'll get to some more examples. Let's go the other way, listeners. Let's go to the down and out put, a.k.a. the new branding that Dan is going to be embracing soon for MTM. Write in if you're down with that, listen. Maybe write in with some of your own AI jiggered screenshots. Like I have a fun AI face of Dan with a top hat floating around behind me today in the studio. Which always puts a smile on my face whenever I see it, Dan. I just get a nice chuckle out of it. So thank you for that, sir. but I'll need to make a new one, Hobo Dan, with his bottle of Malort in the alley. I like it, but I digress. Down and out puts. Let's go out to XYZ again. This time you're going to the downside. Let's say XYZ is trading $50. So you buy a 50 strike put. In this case, it's a longer term trade. Let's say 6 months. You're buying a lot of protection. You're buying at the money put going out 6 months. Guess what? You want some protection. But in this case, you decide in your infinite wisdom to go OTC and buy a barrier option. And this barrier option is constructed so that put goes out, gets knocked out at the 40 strike. So Dan, you got a nice little pretty much 10-handle put spread. Once you tick below the 40 strike anytime in 6 months, guess what, sir? That put is worthless. So if XYZ goes the way of the dodo, that put you hold in your hand, you might as well tear it up, sir. It's useless. What do you think?
Yeah. So this you're talking about the down and out put.
I am. Yes. It gets knocked out if you break the 40 strike.
Yeah, which is, I mean, this one's kind of a weird one. I mean, I'm just going to say, like, it's kind of a weird one.
I think they're both pretty weird, but, to each their own. So, excuse me, too much Malort here in the studio, Dan. But, yes, so I think astute listeners will already be asking themselves this question, Dan. Why the F would I ever buy these things? They are ridiculously limited use case things. And I think you can maybe, on the other side of that, probably intuit what the benefit of these. I mean, they're very limited utility. So guess what? They're going to come with a cheaper sticker price. That's just the case. So if you want to go out, maybe you look at that 50 strike put or that par call and you decide, you know what? Those are too expensive. I'm going to go on the upstairs market and get myself a knockout version instead. You're going to save some money. So in that scenario, that is a good thing. These are popular actually also in FX because you have a very specific movement that maybe you want to hedge against with a down and out put, or you want to speculate onto the upside. Remember, FX, these are pairs, so they're moving one currency against another. So you might have very specific windows you want to trade in. So there are more use cases in the FX landscape. But outside of those, they are pretty rare. And also, Dan, I think also our astute listeners will realize, well, if I want a par call that's cheaper, that effectively knocks out at the 120 strike, I'll just buy the par 120 call spread. It's cheaper and it still kicks out at the 120 strike, but it doesn't become completely worthless, Dan. It still has some value if the stock closes at 119. What are your thoughts on that as an alternative, sir?
Yeah, I mean, it seems to me that a lot of the reason why some of these are created is to be more set it and forget it and not have extra management involved. But I mean, if the strike price, for an up and out call, if the strike price is 100 and the barrier is 120, which means the call disappears at, it's knocked out and becomes worthless at 120. Seems to me like there's some extra management involved instead of less management.
Yeah, the utility there, again, outside of FX or some very limited speculative scenarios, I don't see a reason why you'd really, unless it's just that much dramatically cheaper, Dan, than buying the par call straight up. But again, you tick 120, that call, it's not like it's a call spread where it still has that value left. It's worthless. It's gone. It's knocked out. So that is a high degree of risk.
Yeah, I sorry to interrupt, but what's kind of interesting about it is, I guess it really is how big is the price difference? Because like I have, and I don't do a lot of these, but I've done some like broken wing butterflies or something where, you're bullish, you want the stock to go up into that, that sweet zone right there. But if it goes up too much, then you're kind of screwed. Here you're kind of less screwed. So it's sort of almost a similar kind of concept. And I just wonder, that's the fun thing about options is you can get creative with them. And I just wonder if you got really creative with this, if you could set up some pretty good like income type strategies and focus on the return on capital and such, like I do with my cash secured puts and such.
Our chat's not down for these, Dan. Nichols saying these things are wild. Queen saying, I would never trade these. I would always trade a vertical instead. Yeah, I certainly could see that mindset. At the end of the day, that vertical is always going to have some residual value. It's that binary nature of these, Dan, that kind of makes me hesitant for these. If the call didn't completely go away at 120, if something else happened, then I could maybe see a little bit more utility for it. Maybe it got, all of a sudden it's 50 delta. I don't know. You get half the value. You get something. So you can still participate if the stock keeps running. I'm sure there is an exotic that probably does that. You can call up a big desk if you have a big enough account, listeners, and quote whatever you want. I want my knockout to knock to a 50 delta once it hits this strike. But outside of that, yeah, the utility of these, again, outside of specific scenarios in FX where you got multiple currency pairs going against each other, it's very limited. All right, let's go to the other side of these now, listener. Let's knock in. Well, let's go that way instead. Same deal. Let's go back to XYZ. This time, let's change the numbers just for fun, just to stay sane, Dan. Let's say XYZ is trading $200 now. You buy a 2-month call, and this time we're not just buying a straight 200 strike call. We're buying a barrier and up and in call with the barrier strike being 230. Now, what happens? These are knock-ins, listeners. So this call, quote unquote, that I bought doesn't exist. I have no call until the stock touches 230. Once it hits 230, again, doesn't have to close and expire there. Just has to touch that during that, in this case, 2 months. Then it becomes a plain old call option with a strike of 200 again. So you're kind of just waiting for that trigger moment to happen, listeners. And then once that happens, you've got a plain old vanilla call. So effectively, Dan, what you're kind of buying is an option to buy a par call, sir. What are your thoughts on that? If it hits 230.
Yeah, I mean, I think that's a pretty good way to look at it. Yeah, because, I mean, there's a lot of times where, you just buy the 200 call and, maybe you pay $10 for it. And, if you're between 200 and 210, it's just a big old fizzle anyway. For you to make any money, it's got to be above 210. And so if you get a big enough discount on it, I guess it could be worth it. And I'm trying to think of, just never having been an over-the-counter trader and had to think about these. I'm kind of, and I see, like me, if I were looking at this, I would be looking at prices and I would be looking at spreading it off with regular, well, people call them vanilla options, but I take offense to that. Vanilla is not plain. Vanilla is a genuine flavor.
Are we going to go down that rabbit hole again, sir?
Oh, yeah. This is the hill I die.
You're dying on the vanilla hill.
So, what I would be doing is looking for opportunities to sort of spread these with vanilla options and come up with some creative things where I can eke out, just not an arbitrage profit, but, a lower risk, higher rate of return profit.
Yeah, I could definitely see a use case for these. We'll get to the put in a second, but it's the same kind of thing where, you kind of, again, it depends on the outlay. It's got to be a small fraction, obviously. The price to buy that option, I forgot if it was you I was talking with this about, or maybe it was Matt, one of our other shows, about someone effectively was debating whether eventually we're going to see options on the order types themselves. And because order types have some embedded optionality in them, whether we're going to be able to effectively trade those someday. This is analogous to that. You are effectively buying an option on having a home run call. And so people are buying lottery tickets all the time. This is kind of like doing that, but you're guaranteeing yourself to buy only if it's a home run, listeners. So that I could see definitely a use case for these. You sprinkle a few of these in a meme stock portfolio, for example, Dan, and all it takes is one of these bad boys to hit, and now you're off to the races. Well, same thing to the downside, listeners. We're knocking in on a down and input, so tell Dan to throw off that hobo cloak because we're knocking in. XYZ trading, let's say $80 this time. We're going out 4 months just for fun. The months really don't matter. And the barrier now this time is $70 to the downside. So our option knocks in, aka our put option only exists if XYZ kisses 70 anytime within the lifespan of that option. Could be the first day, could be on the last day. Then that kicks in, and all of a sudden, you've got your plain old vanilla, to use Dan's parlance, 80 strike put. So again, Dan, I could see a use case for these much more than the other ones. Let's say you're looking at a stock and you're like, I don't know, I don't want to shell out all the money for the par calls, or in this case, the 80 puts. But you know what? If it starts running, I sure as heck wouldn't have minded having that par call 30 handles below where the underlying's trading now, or in the case of the put, 10 handles above where it's trading now. So I could certainly see that. Or maybe you're a technical guy, Dan, and you think if the stock XYZ, for example, if it breaks to the upside, if it breaks, let's say, a resistance at 230, now you're like, okay, the stock's going to kick into another gear and really move to the upside. I could see a use case there as well. You sprinkle some of these at the levels where you see support and resistance, and then if it doesn't get there, you only paid a fraction of what you would have paid for the regular call. But if it does get there, guess what? You're doing pretty well. And obviously, from a hedging perspective, it makes a hell of a lot of sense because you're getting that catastrophe hedge, but you're only paying a fraction of the amount for it, Dan. So again, I could see a lot more utility for these. What are your thoughts, Dan? Are you ready to knock in, sir?
Yeah, sometimes you have to think about things a different way to understand them. You know, you have to sometimes think about it backwards. And thinking about the put is a lot more intuitive. But if a down and in put makes sense, and up and in call would also make sense. And so, yeah, this one I think clicks a lot easier because this is a situation. I mean, this is a regime in the market here where I have some puts on the market, and I look at them and I think with my mind's eye, well, okay, how far do I think the market's going to go down? I don't think we have a 20% crash coming or anything like that. And so then you start thinking, well, okay, with time decay, where do I put in my good till cancel limit order to sell these puts? And a lot of times, if you're only expecting like a 3-4% pullback, it's like, geez, if this move doesn't happen pretty soon, this is really going to suck. I mean, what I really want is this disaster insurance. I want cheap insurance. I can withstand a 3% dip or whatever. I mean, this example with 80 and 70 is more than that. It's 12%, but still, I can withstand a 3% dip or something like that. But if there's a big disaster, holy cow, it would be really nice to, if it goes down below 70, it'd be really nice to say, oh, boom, there's that put with an 80 strike price. It now magically exists. There's some value there. And then it doesn't take a lot of extra thinking to make a similar case for the call version of that.
Yeah, I can see a lot of utility for these. So I'd have to wonder how much cheaper they are, because any big desk is going to realize they're still stopping you out at 70 on that stock to the downside and giving you all the upside north of 230. So they're still going to charge you, I would think, a fair amount for that. But again, I haven't gone to price these in a little while, which brings me to the cons of these, listeners, and they are legion. First off, as you said at the top of the show, these are strictly OTC, at least for the foreseeable future. I have not heard any exchange coming out. And, maybe with the meme stuff, Dan, maybe I could see down the road an exchange flirting with the knock-in calls, maybe, just as a way to kind of cater to even more of that kind of cheapy lottery ticket crowd, because that's pretty much what you're doing there. So maybe I could see an argument for that down the road, but I'm again, that's pure conjecture. No exchange has come to me off the record, Dan, and be like, psst, we're working on exotics. That's coming next. So tell Dan to get ready in his hobo outfit. We're going to knock out. But I'm going to get down and out. That's what it was, yeah. But so, yeah, these are strictly OTC. So obviously, all the barriers to entry are there. You need a high high capitalization to access these. And liquidity is non-existent. You are the liquidity. When you call up the desk and quote these, that's the market. Take it or leave it. Maybe if you're big enough, they'll trade in between for you, but that's really about it. So forget about liquidity. Forget about all the other things we talk about here. Also, we talk about the value of these. You're not going to go throw your old Black Scholes on this and say, hey, that's what it works like. You got a bunch of various simulations. You got to run Monte Carlos and everything else because you have a bunch of conditional probabilities that are baked in here. What happens if you're north of 230 or south of 70 on the puts? So there's a lot of funk that goes into the actual valuation of these, very complex. As I alluded to earlier, these are quasi-binaries in a certain sense, especially of the knockouts, because you get to a certain level, it's a binary of the zero end. It's just gone. So something to bear in mind if you don't like, your traditional, either a binary type payout or the more non-linear type payout than you're used to. These are not for these. Also, managing risk in these, much more challenging. And again, as we said, these are OTC, so you're not going to be able to go and do a 10 lot of these on TD, Ameritrade, or Robinhood anytime soon. These are effectively non-existent for most of you out there. Now, then again, I mentioned at the top of the show, especially with the knockouts, you can replicate some of these, and you can replicate the knock-ins too to a degree, maybe if we're talking ratio spread, selling one, buying two or three, depends how you structure it. You can effectively knock in at a certain level, more risk involved in those, but you can construct these on your own, just takes a little bit of wherewithal. So Dan, what are your thoughts on our second foray through the world of exotics, sir? Anything you want to leave the folks with?
Yeah, I just figure I'll pick up the ball and run real quick with what you were just talking about there, Mark. Being able to construct your own, if you think about it, like with the put knock in, if it goes down, then you would have to buy a put, but then it would be expensive instead of cheap. But that's only if you're looking at that one trade. If you consider, okay, I do this 10 times and I only actually buy the put on that 1 out of 10 times, and I save all that time to get on the other 9 times, like, I think that's the way I would think about the pricing. But anyway, yeah, this was a fun episode. I liked this.
I too enjoyed it, sir, Dan. So dare I say we might have to get exotic again, sir. What do you say? There's more exotics out there, listeners. So if you want more of this will be our next thing. What was our last thing? Oh, it was forgotten terms. Maybe this will be our next thing, Dan. We'll become the exotic options show. In the meantime, Dan, if folks have questions about these, and I can clearly see why they would, or anything else in the world of options, where should they go? What should they do?
Sure. This would be a great thing to head on over to markettaker.com, 2 T's in a row. And we're glad to help you out with any of your option trading education needs or wants.
Yes, check them out, mtm.com, and don't forget to send in your Hobo Dan AI created images. The best one might win a prize. So, and I'll put it up on the screen behind me here in the studio, which will be just a cherished memory for all time, listeners. In the meantime, if you want more cherished memories with Dan and I, then you're in luck if you're hanging out in the Pro. I see you folks asking, is a doubleheader today? Yes, it is a doubleheader Wednesday. You folks are in luck. You get 2 for the price of 1. So hang out in the Pro. We'll be back in a little bit. If you want to join our friends in the Pro, only one place to do it. It's pretty obvious. theoptionsinsider.com/pro. That's the place where you go to knock in. See what I did there? You can knock into the Pro and check out all the cool stuff that we have cooking. In the meantime, Dan and I will be back in your ear holes instantaneously on the Pro. For the rest of you, see you back here next week. Another episode of Options Bootcamp. Oh yeah, and stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.